The global economy has been holding its breath. The US and China, the world's two largest economies, are locked in a trade war. Tit-for-tat tariffs have been imposed on billions of dollars worth of goods. This has disrupted supply chains, raised prices for consumers, and fueled uncertainty in the global market. However, a glimmer of hope emerged on May 12, 2025. The two economic giants agreed to a 90-day tariff truce. This truce is a significant development. It offers a window for negotiation and de-escalation. Under the agreement, U.S. tariffs on Chinese goods will be reduced from a staggering 145% to a still substantial 30%. China, in turn, will lower its tariffs on U.S. goods from 125% to 10%. The fentanyl exception, however, remains a point of contention. Tariffs related to fentanyl imposed by the U.S. earlier this year will stay in place. This temporary ceasefire is a significant step back from the brink. It signals a willingness from both sides to find a negotiated solution. The high tariffs imposed had threatened to plunge the world into a recession. Businesses had been grappling with the uncertainty, leading to delayed investments and reduced hiring. The truce, therefore, comes as a much-needed breather for the global economy. The next 90 days will be crucial. Both sides will need to demonstrate a genuine commitment to resolving their differences. A failure to reach a lasting agreement could lead to a re-escalation of the trade war. This would have devastating consequences for both countries and the global economy. The world is watching, hoping for a return to economic stability and cooperation. The trade war, even with the recent truce, has left its mark on the global economy. The risk of a recession, while mitigated, has not entirely disappeared. Goldman Sachs, for instance, lowered its prediction of a U.S. recession to 35% from 45% following the truce announcement. While this suggests a more optimistic outlook, the fact remains that the risk is still significant. Inflation is another area of concern. The trade war has resulted in higher prices for consumers. From clothes and electronics to everyday household goods, the cost of living has been steadily increasing. The tariffs, even at their reduced rates, will continue to impact household budgets. Yale's Budget Lab estimates that the average middle-class household will spend an additional $2,237 annually due to the tariffs. Unemployment is also a looming threat. As businesses face increased costs and uncertainty, job losses are a real possibility. Yale estimates that the tariffs could result in 456,000 job losses in the U.S. by the end of the year. This would be a significant blow to the U.S. economy and could have ripple effects across the globe. The trade war's impact on GDP is another worrying factor. Yale projects that the tariffs will shave off 0.7 percentage points from U.S. real GDP growth. This slowdown in economic activity will have far-reaching consequences, potentially impacting investment, wages, and consumer spending. The 90-day truce provides some breathing room, but the underlying economic risks remain. The announcement of the 90-day tariff truce sent a wave of relief through global markets. Stock markets around the world surged as investors reacted positively to the news. Hong Kong's Hang Seng Index, heavily influenced by Chinese companies, saw a significant jump of 3.4%. In Europe, Germany's DAX rose by 1.2%, and France's CAC climbed by 1%. The U.S. stock market, a key barometer of global economic sentiment, also responded favorably. Dow futures leaped by 2.1%, while the S&P 500 and Nasdaq futures surged by 2.7% and 3.6% respectively. This positive response reflects the market's anticipation of a potential easing of trade tensions. The US dollar, considered a safe haven asset, strengthened following the truce announcement. The ICE dollar index, which measures the greenback against a basket of other currencies, rose by 1.3% to $102. This suggests that investors are becoming more optimistic about the US economy's prospects in light of the truce. Commodities, often seen as a gauge of global economic health, also reacted positively. Brent crude oil, a key benchmark, saw its price rise by 2.8%. This uptick in oil prices indicates renewed confidence in global economic growth prospects, as reduced trade tensions could translate into increased demand for energy. The 90-day tariff truce has elicited a range of responses from key figures involved in the trade negotiations. U.S. Treasury Secretary Scott Bessent hailed the agreement as a historic fresh start. He emphasized that neither country desires economic decoupling and highlighted the U.S.'s strong position in the negotiations. Chinese Vice Premier He Lifeng, a key figure in China's economic policymaking, described the talks leading to the truce as candid, in-depth, and constructive. This suggests a willingness from the Chinese side to engage in meaningful dialogue to resolve the trade dispute. President Trump, who initiated the trade war, lauded the agreement as a great trade deal and a total reset in relations with Beijing. His positive assessment of the truce reflects his administration's desire to portray the agreement as a victory for the U.S. However, not everyone shares this optimistic outlook. Analysts have expressed cautious optimism, noting that U.S. tariffs on China, though reduced, remain high. Concerns persist about the feasibility of reaching a lasting ceasefire and the potential for renewed tensions in the future. Pier Giuseppe Fortunato, a seasoned analyst, believes that the U.S. made more concessions in the truce agreement, reflecting its greater economic reliance on China. He predicts that U.S. tariffs will eventually settle at 15 to 20%, still higher than pre-trade war levels. Section 5. Echoes of the past. The current U.S.-China trade war has drawn comparisons to the U.S.-Japan trade war of the 1980s. Both situations involve economic superpowers clashing over trade imbalances, technology, and market access. The 1980s saw escalating tensions between the U.S. and Japan, with the U.S. imposing tariffs and quotas on Japanese goods like automobiles and electronics. However, there are key differences between the two trade wars. The U.S.-China trade war is far broader in scope, impacting a wider range of industries and having more significant global implications. China's economy is more deeply integrated into the global economy than Japan's was in the 1980s, making the stakes much higher this time around. The U.S.-Japan trade war was eventually resolved through the Plaza Accord of 1985. This agreement saw Japan agree to appreciate its currency, the yen, making Japanese exports more expensive and U.S. goods more competitive. Whether a similar resolution is possible for the U.S.-China trade war remains to be seen. The Plaza Accord, while successful in easing trade tensions, had unintended consequences. The rapid appreciation of the yen contributed to asset bubbles in Japan, which eventually burst, leading to a prolonged period of economic stagnation. Any potential resolution to the U.S.-China trade war will need to consider the lessons learned from the past. Section 6. Charting a course through troubled waters. The U.S. and China, in response to the trade war, have been adjusting their long-term strategic approaches. The U.S., under the current administration, has been pursuing a policy of economic nationalism, emphasizing domestic manufacturing and reducing reliance on China for critical goods and technologies. This reshoring of manufacturing is a central tenet of the U.S. strategy. The goal is to bring back manufacturing jobs to the U.S. and reduce the trade deficit with China. However, this strategy faces challenges, including higher labor costs in the U.S. and the complex global supply chains that many industries rely on. China, on the other hand, is focusing on self-sufficiency, particularly in strategic sectors like semiconductors and green technology. The trade war has exposed China's vulnerability in these areas, as the U.S. has restricted access to advanced technologies. China's strategy involves massive investments in research and development, aiming to become a global leader in key technologies. The goal is to reduce dependence on foreign suppliers and create a more resilient economy. Section 7. The Global Chessboard. The U.S.-China trade war has far-reaching consequences, extending beyond the immediate economic impact. It has become a catalyst for a broader realignment of global trade patterns and geopolitical alliances. Countries are being forced to choose sides, potentially leading to a more fragmented global order. One potential outcome is the emergence of regional trade blocs. Countries may prioritize trade agreements with nations that share similar values and economic interests. This could lead to a decoupling of the U.S. and Chinese economies, with each superpower heading its own trade bloc. The trade war has also highlighted the importance of alliances. The U.S. has been strengthening ties with allies like Japan, South Korea, and Australia, partly to counter China's growing influence in the Asia-Pacific region. China, in turn, has been deepening its relationships with countries in Southeast Asia, Africa, and Latin America. The competition between the U.S. and China is not limited to trade. It extends to technology, military power, and ideological influence. The trade war is just one manifestation of this broader rivalry. Section 8. The Innovation Imperative. The trade war, despite its negative consequences, has inadvertently spurred innovation in both the US and China. Faced with tariffs, supply chain disruptions, and technological restrictions, companies in both countries are being forced to become more resourceful and innovative. In the US, the trade war has re-energized calls for investment in research and development, particularly in areas like artificial intelligence, robotics, and advanced manufacturing. The goal is to maintain a technological edge over China and create high-paying jobs in cutting-edge industries. China, already a leader in areas like renewable energy and 5G telecommunications, is doubling down on its commitment to innovation. The government is providing generous subsidies and incentives for companies to develop indigenous technologies and reduce reliance on foreign suppliers. The trade war, in a way, has created a sense of urgency for both countries to accelerate innovation. This competition, while disruptive in the short term, could lead to breakthroughs that benefit the global economy in the long run. Section 9. A New World Order? The US-China trade war is a symptom of a larger shift in the global balance of power. China's economic rise, coupled with its growing military and technological capabilities, has challenged the US's long-standing position as the world's sole superpower. This has led to a period of uncertainty and readjustment in the international order. The outcome of the trade war and the broader US-China rivalry will have profound implications for the future. It could lead to a more multipolar world, with power distributed among several major players. Or it could result in a new Cold War, with the US and China locked in a protracted struggle for dominance. The 90-day tariff truce provides a glimmer of hope that a full-blown trade war can be averted. However, the underlying issues that led to the trade war, economic imbalances, technological competition, and geopolitical rivalry, will persist. The world is at a crossroads. The decisions made by leaders in Washington and Beijing will shape the course of the 21st century. The stakes are high not just for the US and China, but for the entire global community.